Good morning. Welcome to the California Mortgage Bankers Association Mortgage Quality Assurance and Compliance Conference, Compliance Committee monthly call. I am Ray Steichel. I am the chair of the committee this year. I'm lucky that I get to kick it off myself and for the first time. Susan will not be here, but hey, the rest of the team is here. I'll get to it in a minute. I would like to remind everybody, by the way, we have the Legal Issues and Regulatory Compliance Conference in December 7th and 8th in San Diego. So please, put that on the calendar, sign up. Any questions on that, of course, reach out to CMBA, but the California Mortgage Bankers Association. But we look forward to seeing everybody there. Right now, I'd like to hand it off to our friend and actually our controller today of the slides, Jim McCracken from the Compliance Group. Jim.
Thank you, Ray. The Compliance Group, we're so very proud to support the efforts of the California MBA and especially the Mortgage Quality and Compliance Committee. This committee is just one of the ways that Susan and her team promote advocacy and provide information to all of us. For the past 21 years, the Compliance Group has been providing our clients with broad-based compliance-related services, such as federal and state audit preparation, internal audit, AML, and federal and state-based file reviews. We also provide quality control as an outsourcing solution for pre-funding, post-closing, and loan servicing. At the Compliance Group, our leadership values integrity and unassailable ethical standards. We are very passionate about producing the highest quality work and exceeding our clients' expectations. Our mission is to create highly engaged partners by supporting their efforts in effectively managing their compliance and quality risks. Thank you for joining us today and for supporting the California MBA. Ray, I'll turn it back to you.
Thank you, Jim. Okay, well, today topic, and I want to sure I get this right, the trending QC defects and monitoring and QC best practices what we're covering today. Today, our speakers will be Jeff Flory and Nick Volpe. Jeff, let me cover where Jeff has come from and who he is. And I always forget, let me read, but I always think it's worthy because people have earned this. Jeff Flory serves as a Senior Vice President of Sales and is responsible for sales and marketing strategy for the Compliance Group. Mr. Flory joined TCG in October 2018 and brings with him a background encompassing all aspects of mortgage lending. Jeff started his mortgage career in retail lending, working for a Pleasanton-based mortgage brokerage before moving to Coast Federal Bank's retail team, earning recognition for sales performance. Jeff returned to Southern California in '96, where he held leadership roles in both sales and operations for wholesale and correspondent lending and technology at Option One Mortgage and Aurora Loan Services. In 2009, he moved to service provider space, working for a default outsourcing firm, Equifax, and spent the last 7 years at Interthink's First American in sales leadership roles prior to coming to TCG. Jeff was a former member of the MBA's Future Leaders Program in 2005, successfully completed the Schools of Mortgage Banking in 2006, earned his AMP designation, and was awarded his CMB designation in 2013. He's a graduate of UC Santa Barbara. Welcome, Jeff. Let me cover Nick as well as we can, and then I'll have you guys take it from there. Nick Volpe brings over 20 years experience in both mortgage origination and servicing to ACES. He was part of the original team at the Murray Hill Company and was integral in the pioneering credit risk oversight for mortgage loan securitizations. Prior to joining ACES, Nick helped establish origination and servicing QC businesses and led integration teams in multiple acquisitions. A recognized subject matter expert, he has authored multiple articles and speaks regularly at industry events. In his role at ACES, he maps the course for future product development, executes corporate initiatives, and works directly with clients to chart market needs. So Nick has a bachelor's degree in real estate finance from Penn State and is married with 2 children. So as usual, we do with California Mortgage Bank Association. They bring really high caliber people to presentations, and today's no exception. So with that, welcome, gentlemen, and take it from there.
All right, thank you. This is Nick. I'd like to thank Ray and the CMBA for having me today, and thank you to Jeff and the Compliance Group for sponsoring this. I'm really excited to be here. So to kick us off today, I wanted to share some critical defect data. It should give us a nice path to talk about the rest of the topics in today's session. The data is derived from lenders that perform post-close quality control reviews in our software. And usually each quarter it's around 100,000 reviews that encompass this data. It's been a little bit higher than that, obviously, for the last couple quarters because of the amount of volumes and refis and whatnot. But it's at least 100,000 reviews every quarter. The most current data and what we're going to look at today is through Q1 2021. So let's start with just the overall critical defect rates, and this is a one-year view. You can see that they've declined for 2 straight quarters. That's certainly a positive. One thing that's interesting to me is that the data shown here starts with Q2 2020. So it's essentially representing the COVID-19 pandemic, kind of when it began back for, at least for the United States, in call it March or April of 2020. And so really the critical question here is whether or not defect rates will revert back below the 2% mark that we saw for most of 2018 and 2019. So these are definitely higher than what we've seen over the last 12 quarters or so, peaking obviously in Q3. So we're going to explore some of the things behind these elevated defect rates as we get through the presentation today. But I think you'll notice really 2 common themes. The first is the pandemic, obviously, right? That's been probably the biggest single event in any of our lifetimes. And the second is lending volumes and kind of their effect on defect rates and loan quality. So Jim, you can go to the next slide. Before we talk about those themes though, let's look one layer deeper at the defects and see where they're coming from. So this next view is showing where defects are dispersed across the Fannie Mae defect categories. Income and employment continues to lead all defects categories, and it's responsible for almost 1/3 of all defects. One thing to note here is that the 31% share is an all-time high. It eclipsed the previous high of 30% set in Q2 2020. So pretty clear that the pandemic was not kind to income and employment underwriting. So along with income and employment, that's 1/4 of what we call the core underwriting categories. The other 3 are assets, credit, and liability. Those 4 categories combined give you a real good idea of borrower health. They also represent key parts of the manufacturing process. And you could argue that they're also the most difficult parts to underwrite as well. So we pay particularly close attention to those. In total, those 4 categories made up 60% of all defects for the quarter. One area to watch going forward is the regulatory compliance category. Defects in this category were only 9% of all defects. That number is a little bit below previous quarters. And really that number has surprisingly trended down throughout all of 2020. While the pandemic brought significant regulatory changes and challenges, the most operationally impactful of those challenges seem to be on the servicing side. I would say lenders shouldn't get lulled to sleep though. We all know that the regulatory environment will ramp back up. I think there's been a fair amount of noise around fair lending and that being a regulatory focus going forward. So while we're obviously excited to see a improvement in the defect impact due to regulatory compliance issues, we shouldn't take them for granted at this point. Jim, next slide. Let's next take a quick look at the subcategories. Basically, these are the specific issues that drive the defects. I want to focus on the income employment category again. Obviously, 30%, 1/3 of the defects, so the most important category in my opinion. As you can see, there are 3 subcategories in the income, and those are income calculation, income documentation, and income eligibility. We consistently saw income documentation be the largest subcategory throughout the pandemic. And those percentages really spiked early on, most likely due to the difficulty that lenders had in verifying income. When everything shut down, employers moved to remote work, just was not as easy to get timely responses. So when you combine that COVID and work from home disruption with the record volumes that we saw during last year, as well as a rapidly changing employment environment, those numbers aren't all that surprising. I would say this is an area where lenders could and should focus their efforts going forward. With underwriting times extended, there is that much more issue, that much more ability for things like expired documents or not current documents to make them into the final files. And so we're seeing a lot of that in terms of just the pure documentation needed for those categories. I would expect, because, well, for a couple of factors, right? Volumes are moderating a bit. And we've kind of settled into a groove here the best we can with the pandemic. So I would expect some moderation in income and employment defects overall as we go forward. But these are really important categories and subcategories to keep an eye on in your own business, as they are critical defects. They're not often able to be cured, so they can lead to repurchase, certainly. So we're going to show two more quick data views here. Jim, you can go to the next one. So both of these last two really illustrate the effect of lending volumes on defect rates, and they really give you a feel for what lenders were up against last year and going into the first part of this year. The first one here is a mix of the refinance and purchase transactions. So refinances made up nearly 60% of all reviews, with purchases making up the remaining 40%. One thing I would caution you here is this is QC data, so there is sampling involved, so it's not necessarily 100% reflective of the overall market, but certainly directionally correct. Refinances were somewhere around 2/3 or a little bit more of the overall market too. So refinances, they were, like I said, 60%, purchases 40%. What's really relevant there is the percentage of defects. So on the left side, you're seeing the percentage of the reviews that were done on purchases and refinances. And in the right pie chart, you're seeing the percentages of defects that were attributable to each one of those. So refinances, they were 60% of the reviews, but were really only 50% of the defects. So what that tells me and gives you a good indication of is that refinances perform better than purchases, or more accurately, I guess, they were less likely to have defects. That's really in line with what we had seen and expected historically. One thing to point out is that I found interesting is that during the pandemic, that repurchases actually underperformed, meaning they were more likely to have a defect than a purchase. So I know Jeff is going to explore that a little bit further here when he's going, but needless to say that in Q1 2021, we saw a bit of a reversion back to the norm in terms of refinance versus purchase defects. Okay, so last data set here. Jim, you can go ahead and go to the last chart. This one shows the share of conventional versus government lending. It's not surprising that conventional market share dominated in the low interest rate environment that we had, high refinances. We did see that share came down a bit from the refinance peak, where for most of 2020, the conventional share was 75% plus. So as we got into 2021, we're seeing that come down a bit. So I would expect, conventional share to continue to decline in the coming quarters as we transition into a more balanced purchase and refinance market. I would also expect that conventionals make up a proportionally lower share of defects as government lending increases. So kind of similar to what we went through with purchases and refis, we typically see overperformance, if you will, in conventionals where their defect share is lower than their actual review share. And during the pandemic, we didn't see it. Now, conventionals just so completely dominated the market, it's not entirely surprising that came out. And when you consider some of the government refinance programs, very low expectation of defect rates for things like VA IRRRLs and FHA streamlines. And so that when you have a high refinance market, we don't see a ton of those defects. So just kind of a couple of observations here to close out the data portion. First is, we're moving into a purchase market. I think that's pretty clear. We expect lower volumes overall in 21 and 2022. And so while that's not necessarily great for our overall market, we would expect some pickup in performance in a lower volume environment, meaning less defects through the QC process. The second, kind of observation here is that COVID clearly had some level of disruption to underwriting. But we would expect that now that enough time has passed, lenders are finding ways to adapt. They're settling into processes that work in a work from home environment for not only for their staff, but for the employers and other folks that they rely on to get information. And we feel like that should have a positive impact on defect rates as we go forward as well. And then kind of the third and last point here is, I think a transition to a higher purchase share brings a whole new set of risks that may have not been present when 7 or 8 out of every 10 loans was a refinance. So, lenders should certainly be mindful of that. And it will come down to how lenders really adjust their processes, adjust their staffing to account for lower volumes. And to be able to account for the different risks that they haven't really had to worry about in the last 18 months or so. So that'll be something key to watch here as this data comes in for the rest of 2021 and into 22. So Jeff, now that we kind of know what the defect data is telling us on QC defects, what should lenders be doing?
Nick, thanks for all that. My portion of the presentation today probably focus on a lot of things you already know. I'm not going to profess to be an expert in QC or compliance. I mean, there's probably people on this call who read Dodd-Frank in its entirety for fun, and there's no way I'm flexing on a guy like Raymond who lives, breathes, and eats this stuff. But I liken the roles that Jim and I play to traders along the route. I mean, of course we have things to sell, and that's our primary job. But in the old days, those traders were also valuable collectors of bits and pieces of information that were passed along to stop after stop along that route. And so in the same vein, my hope and expectation here is that there's a nugget or two that you can take away from this that adds value to your business. And to reaffirm what Nick shared, the title is from the macro to the micro. We are seeing at kind of the file level, we're seeing paycheck alterations, we're seeing W-2 manipulation, hiding self-employment, bank statement issues, occupancy issues, those sorts of things. And of course, as Nick said, there's a reason to believe that it's a lack of resources, incredibly high volumes, and focus on the origination side of the house as all the people move forward that has caused some of the rise in these defects. But you should have a process in place to explore other files within your portfolio that may have some commonalities with a potentially fraudulent file. And if you see little wood shavings on the ground, it's likely you've got termites. And so, we had one client uncovered 2 different fraud schemes in their origination channels, and it was about 75 files total between the 2, and they were tipped off by a singular verification red flag that we reported to them. One of the schemes was, really crafty actually, because the fraudster would basically put, they would occasionally slip in a fraudulent file with several other good ones. So, and that was going on for a couple of years. And we believe that the last 18 months of success have created an environment where the attention to detail has slipped due to volume constraints. And I was actually talking about this with a friend yesterday, but we're moving into a new environment where folks on the front end may be looking for ways to maintain their income levels that may cause potential fraudulent activity to increase, right? I mean, you got to make the Tesla payment, right? Next slide, Jim. So the last 18 months, obviously, mortgage has been a bright spot in the economy. And when you look back to early 2020, interest rates were in the mid 3s, production was pretty robust, but it was also manageable. March of 2020, with the shutdowns, the kind of the chaos of moving operations to remote, dealing with data issues, privacy concerns, continuity of manufacturing processes, coordinating amongst the teams for behaviors. Heck, non-QM dried up pretty much overnight. We saw in April and May, lenders were adjusting to the new norm and then working through the processes and seeing volumes increase at the same time. During that time, Jim and I spent a lot of time talking to each other because no one really had time for us. By June, most originators had made the adjustments and they were pretty much getting hammered with volume. Resources were being pushed to the vanguard of the production line while back office processes suffered. Jim and I at that time, we were finding folks were actually interested in talking again, but it was more probably because they missed the break room and the water cooler conversations more than they really had a need to talk business. By September, cracks were starting to show, production continued to rise, and it reached a high point in Q4, and it strained the resources of originators and service providers like the compliance group alike. And while this simmered down a bit in early 21, the first 6 months of the year was still every bit as frenzied as last year in terms of volumes. So where are we now? Volumes seem to have eased, and now lenders are looking at how they want to move forward strategically from here in terms of managing all of their functions within the operation. And as it relates to quality and quality control, lenders are exploring their options now. They've got a little breathing room to kind of explore, and they could obviously potentially bring the outsourced business in-house if they currently outsource. They could move to outsourcing in terms of moving to a variable cost model, and that is obviously either domestic or offshore. Or we've got folks that are looking at a fixed variable model where they staff to X percentage of their business and they have an outsourced provider cover the remaining portion of production, and then they let the outsourcer absorb the ebbs and flows of the company business. And then the other comment is I'm having a lot of conversations with folks who have different audits they're doing within their organization, and they're looking for ways to tackle the disparate reporting that comes with that within their organization, and having kind of a central depository for defect data that they can use to draw better insights into their lending practices. Jim, next slide. And so what I'm going to cover here is just kind of a couple of different categories of things to kind of be on the lookout for. So if you've made the decision to look outward, it's critical to have a thorough understanding of the performance metrics over the past year and a half of the service providers that you're looking at. What are the operational challenges they had? How have they managed them? No one has been immune to the tight and competitive market for talent. So finding out how they've performed with their existing clients will provide valuable insight into their ability to handle auditing and reporting of your files. And from an internal perspective, established performance metrics are critical. Successful internalization of QC depends on having a realistic model that accurately reflects and adheres to the performance standards that are set. And in the past several years, we've seen internalization efforts be very, very successful. And we've also seen some run into challenges because execution didn't necessarily match up to the expectations that were set in the modeling process. There's also a natural efficiency that develops in an internal QC operation over time as associates become seasoned in the processes, reporting of defects, etc. And in outsourcing, there's a period of time spent calibrating the QC auditors or the QC vendors' audit results with the lender's product mix and credit policy nuances. So understanding the vendor's speed to competency plan can assist to set proper expectations for how long it will take before a lender can settle in and hit the cruise control button and move into what I call ongoing maintenance mode. And because it's possible to have several variations of what ongoing maintenance means, establishing a vendor-client communication rigor will help ensure that a lender's specific needs are being met. As we like to say here, it's your audit, and so we want to make sure that we're meeting your needs. Now, whether internal or external, one critical thing that you don't want to skip in ongoing maintenance mode is the regular cadence calls. You have to be a forcing function as it relates to the regular cadence calls and have an established agenda for each meeting. Because if things are running smoothly and you don't take the time to talk about those things, you could get off the rails. So it's super easy when things are humming and you're busy to turn that meeting into a 30-minute break where you catch up on the kids and sports and dance recitals and grandkids, etc. But don't get caught in that. Make the meeting purposeful and actionable, and do it every month because it's critical to make sure that you're keeping things on the right path. How files are distributed to the team is very, very important. And depending on the size of the organization, you may have less flexibility here, but in a purely manufacturing of widgets approach, files are distributed to auditors as they become available. Other firms practice a team-based approach, managing and distributing client files to teams of auditors, with each client or region then being assigned a specific team. The expectation of clients and outsourcers is that assigned teams will breed more credit policy and nuanced familiarity for each client. And the implementation of a second level review process is highly recommended to help ensure the consistency of the audit results. And this next comment may sound a little contradictory to my previous comment, but from an internalization perspective, you may want to consider shifting teams on a periodic basis. And as I mentioned before, outsourced firms have kind of a built-in separation and kind of a lack of bias in the process. But it's important when you manage in-house to keep the line as bright and clear as possible between your QC provider and your production, and mixing up the rotation every once in a while could help expose some potential risks. Now, the next couple of comments are really focused on the outsourcing side of the business. Internally, you have absolute control over the quality of the associates you hire into your organization. In leveraging an outsourcer, you're relying on them to source, hire, and train quality auditors and processing staff to achieve the results you want. An indicator of a QC outsourcer's potential audit quality can be determined by reviewing their auditor hiring practices. They should have some minimum requirements, 5 years QC auditing experience, proven knowledge of the mortgage industry, thorough understanding of the underwriting process, loan eligibility, compliance requirements, and additionally, QC at its core is a human-powered business. And while technology can be deployed to assist with the process, audits are people, and people will make mistakes. And a robust internal QA plan can minimize the occurrence of errors with elements such as scoring standards for auditor quality, second-level review processes, and a training and development program. And on the pricing front, several elements establish the price per loan of an audit. First, there's the audit cost itself. Pertinent to that are other fees associated with an audit, right? It's the appraisal review fees, bank and employment verification fees, credit report fees. There also might be other fees involved, large file fees, rebuttal fees, technology fees, 4506 processing fees. As you're evaluating QC firms, stacking all of those fees up will help give a more complete and accurate side-by-side comparison of a QC audit's true cost. And I bring up technology, and there's several places you can go with that topic. My main comment here is that the right tools and the right technological partners in the long term should help bring meaningful improvement to your workflows, your processes, and your overall results. You also need to have a committed technology partner to get through the initial change management process, because the natural curve of a technological implementation starts with a decrease in efficiency. And as the users get comfortable with the new technology, you should end up in a better place than where you were before. And this one really ties in with calibration and communication, but whether internal or external, checking your checkers is a crucial component that cannot be overlooked or put on the back burner. Feedback on audits needs to be as timely as possible to ensure that any cracks in the system are identified and remediated as quickly as possible. QC is at its core a human-powered process, and although we'd like to think of ourselves as perfect and impervious to the possibility of making mistakes, it happens. Yes, even Jim and I make mistakes. And the sooner we identify the cause of the error, the sooner it can be corrected. And I was actually speaking with a client the other day that it kind of sheepishly admitted that they were just starting their Q4 2020 reviews of our work, which means that any course correction needed isn't really going to show up until the results of the first 3 quarters of 2021. So very absolutely critical to make sure that you're checking the work not only from an internal perspective, but an external perspective as well. And then finally, and this one again really focuses on the outsourcing world, but in the trust but verify category, a conversation with references can provide very valuable insight as to the satisfaction level of a candidate's current clients. Question lists for interviewing references is a great idea, and ensuring that you have a consistent record of each conversation that you have. Formulate the questions and the interview conversation with each reference. Have to treat it as with just as much important as as much importance as all other components of the vendor evaluation process. And while it's presumed that firms will offer up references to knowingly satisfied clients, having a detailed competency-based question list is going to help maximize the information gathering and expose more details about how each candidate firm operates. I thank you very much for your time. And with that, Jim, I'll turn it back to you. Or am I turning it back to Ray?
Either
I'll
way.
take it from here.
Yeah,
Actually,
thank you, Jim.
Ray, you can take it if you'd like. What we're
No,
going to
go
do is
right ahead.
open it
I
up
think
for
I think at this
questions.
point, I just want to bring up, thank you guys and for handling that and giving us that information. We appreciate it. And of course, we now want to hit the Q&A, which Jim has got the full controls on that. So you got the helm on the Q&A. So and if you have any questions, please enter them there so we can get to them. I think it's in our chat box somewhere in there. Please enter your questions and we'll get them answered. So Jim, what do you got?
The chat box is open, but we don't have any questions yet, gentlemen. So if you have questions, please enter them in the chat box.
Hey, Jim, it's Nick. I can start off with one if you want me to.
Yes, please.
So, Jeff, I guess I'll ask you this one. So, in my opinion, sort of the biggest challenge that we as an industry face going into 2022 is the number of loans coming out of a COVID forbearance plan. I think it's an operational challenge. I think it's the one of the first things on the CFPB's radar. So for a lot of reasons, I think that's our biggest challenge. A lot of those loans are going to be refinanced, right? Which is a positive for our industry. Most of them, because of the increase in property values, are probably in a better place, with the exception of the principal and interest payments that have been part of the forbearance plan, probably in a better place in terms of equity and credit profile than they were before the pandemic. So a large portion of those loans that don't get refinanced, though, will need to go through loss mitigation for modifications, et cetera. What should lenders, servicers out there be doing to make sure that they're incorporating that into their quality control plan?
Well, in terms of the loans actually themselves, and it's ironic because I think Rohit is actually providing his update today to Congress on because he just got appointed obviously a month and a half ago, to he's given his kind of semi-annual CFPB, state of the CFPB, and the things that they're going to focus on. And certainly he's going to be very, very proactive in making sure that lenders, servicers have engaged in the right processes. And so I think, I would imagine that servicers to this point have kind of stress tested their processes kind of in anticipation of these loans coming out. And if not, then I would strongly recommend that they do that to make sure that they have all the T's crossed and the I's dotted in terms of loss mitigation processes, so that they don't get on the radar screen of Rohit and his pals.
Yep. Yeah, I agree. I've been, kind of advocating for the folks I talk to, make sure you are able to demonstrate your efforts in this area, right? That's just as important as doing it 100% right, is the ability to say, hey, we have a QC plan for these types of loans, we follow it. It's not, in my opinion, it's a bigger, it's a bigger and more important issue than just lumping it in with the rest of your QC, right? So, separate teams, sure, maybe targeted adverse sampling for, both loans that get refinanced should have some, quote unquote, special QC designation so that they, those loans can be targeted for targeted reviews, I should say, and adversely selected reviews, in addition to just, hey, put them into the normal sampling engine that we use, and we'll get a couple of them in there. And kind of same on the servicing side, right? I think it really makes sense to somehow be able to flag those loans as a former COVID forbearance loan and run sampling just on those types of loans, and really have, kind of a buttoned up process. So when someone comes knocking, you say, okay, here's the loans that we've run through our quality control platform and process that were, that came out of a forbearance and couldn't or didn't want to refinance, and here's what we did with those, in order to avoid borrower harm and all of the things that, Rohit and the rest of the team are likely going to be looking at.
Yep. Great question. Any more questions? I don't see any questions in the chat box. We'd love to hear from folks that have questions for either Nick or Jeff.
Don't be shy.
So if we don't have any questions, Ray, do you want to go ahead and do the wrap up?
Yeah, if I could. So, okay, well, with that, again, thank you, gentlemen, for presenting. Greatly appreciate that, and always important to get information. I will tell you, in the QC space, particularly, I think one of the things we're seeing is as you kind of noticed in the industry, was the volume, and that's the timing issue. I'm sure, we'll see once we get that settled out. How is it going? Going back to your point, Nick, are we going to see things a little bit differently going in the future in regards to anything? And in this case, it's going to be loans that were either in forbearance, et cetera, and how that's going to trend, because getting a lot of scrutiny still in our industry hasn't gone away, right? If we survive this, it was only, 2008. To me, it sounds like it was 3 years ago, but it's been a while. But we've always been now under the gun. And Jeff, just for your point, I did not read Dodd-Frank completely. It was admittedly, it was quite a page turner, I have to say. It was just great and stuff, and particularly TRID, it's fascinating. But thank you otherwise. Okay, well, with that, I want to thank everybody for attending, and remember again, we have the Legal Issues and Regulatory Compliance Conference in San Diego, December 7th and 8th. We will have another one of these, of course, next month, so keep an eye on that. And so with that, Jim, again, thank you, gentlemen, and we'll see you all next time.
Thank you.
Thank you all.
Thank you all.
Good afternoon.